You can also use options to generate income based on your stock portfolio. And this is called covered writing. We'll get into this when we get into the 21 strategies. This is a very conservative strategy. You cannot lose money by writing options against your stock holdings. If the stock goes up, the option's called away. You made money on the stock, no doubt, and you've also made money by selling the option. You can use an option to buy stock at a lower price, and we'll get into that. You can position yourself for a big move in the market, and it doesn't have to be up, it can be down. Options allow you to make money in markets that go up. They allow you to make money in markets that go down, and they also allow you to make money in markets that go sideways. Moreover, there are option strategies that can help you capitalize on markets that go up only slightly or only down slightly. And like I said, when we get into the advanced strategies here, you'll see that there's an option strategy for virtually any kind of market you can find. Now, the difficulty comes in, one is understanding the strategy, and two is, and this is the most important thing, is you need to know what kind of market you're in and what your stock is likely to do. And there's no easy answer to that, I'm afraid. You can also benefit by using options from a stock price rise, in which case you buy options instead of stocks, you get much better leverage. Now, leverage means the ability to control an asset worth many more times than what you put up. So if you have to put up 100% price of a stock, with an option you may only have to put up 10% of that. So you can have 10 times as much shares under control when you purchase a call option than if you buy the outright security. Now, there are two sides to options. There's a buying side and a selling side. There's always a buyer, there's always a seller. And both parties to the transaction have to agree to a single price. So that when you go into the option market, there's a bid price or a buying price, and there's an offer price or a selling price. The two parties, buyer and seller, have to agree on one price. Only then does a transaction take place. As a buyer, you have certain advantages and disadvantages, and likewise as a seller, you have certain obligations and certain advantages and disadvantages. For the buyer, there's strictly limited risk, and by that I mean if you buy an option, whether a put or a call, you pay a premium for that, and you cannot lose any more money in the market regardless of what happens subsequent to buying that option. Your risk is now limited at the outset, and you know what that risk is. And as we get through the strategies, get into the strategies here rather, we'll talk about what is the risk, what is the potential. And remember, there's always trade-offs. Every time you buy or sell an option, there's a trade-off of some sort. If you want to cut down the cost of the option, there's a way to do that, but by cutting down the overall premium cost, you're also cutting down the ability to make money with that option. Some of the profits are unlimited, as in when you buy a put or a call, especially a call, because the market can go to infinity. In the case of a put, which gives you the right to sell the underlying stock, the stock can only fall to zero. So an option provides the right, but not the obligation, and that's significant, by the way, to buy or sell a stock at a predetermined price on or before a specific date. Now, I have to say that options are more complicated than simply buying stocks. When you buy a stock, typically you put up 100% of the cost of that stock, and then you have the right to own it just as you would a house, to hold on to it once you own it indefinitely. In the case of a call option, you're buying the right to purchase that stock at a specific price known as the strike price. And also, you have that right only during the duration that the option is in existence. So if you buy an April 25 call, you have the right to buy the underlying stock at 25 at any time up to the third Friday in April when the call option expires. After that point, you've lost the ability to exercise the option. So the call, there's both puts and calls, and I understand this is elementary, but we need to cover it. A call is the right to purchase a stock, whereas a put is the right to sell a stock. As a call buyer, you have the right to purchase the stock at the strike. As a put buyer, you have the right to sell the stock at a specific price. The person who purchases an option, of course, is known as the buyer. The person who sells the option is known as the seller or the writer. And I use these terms, I use both these terms, seller and writer. They mean the same thing. Occasionally you hear of the option seller as the grantor of the option as well. So options are contracts in which the terms of the contract are standardized. And this is important because before there were listed options in the early 1970s, I think it was 1972 when the CBOE, that's the Chicago Board Options Exchange, came into existence, there were puts and calls. But if you wanted to buy a call, you had to go to your broker and find someone willing to write that call. In other words, to take the risk to permit you to buy the underlying stock at the strike. Now, because they're listed, they're standardized, meaning when you go into the market and you want to sell this option that you bought, and because the underlying has gone up at a profit, there's someone to take the other side of that, and that's very important. So if you're dealing in a stock like, say, Disney, you just tell your broker, I want to sell 100 shares of Disney at the market, 1 or 2 at a limit price, say at 30. In the case of the call, it's not that easy. It's more complicated, I should say. In the case of a call, you have to say, I want to sell 1 April 25 call at the market, or I want to sell the April 25 call at a price of 30 if you're using a limit order. Now in this video, we're talking about theory primarily, but it's important that you understand the theory, because when you get into the actual practicality of the market, you'll find that very often the theory is not quite as clear. It's a little messier. For example, if you see a price on the screen on your computer for an option, it doesn't necessarily mean that you'll be able to trade the option at that price. It means the last trade was at that price. It means a buyer and a seller agreed to both buy and sell that option at that price. But if you're in the market yourself and you want to sell your option, you've got to come up with a price you're willing to sell it at, or you have to do it at the market. Now, what happens as a practical matter in the market? Like I said, there's a bid price and an ask price. So if you want to be a buyer and you put a market order in, guess where you're going to get filled? At the higher ask price. If you're selling and you put in a market order, you're going to be filled typically at the bid price. That's why it's important in the option market to often use limit orders, where you specify the price and your broker cannot bid it higher if you're buying, and he cannot offer it lower if you're selling. So the contracts are standardized so that when you go to sell your option, you're selling the specific details of that option. The April 25 Disney call. So you know it expires in April, you know the strike is 25, and you know Disney is the underlying stock. If you were to say, sell me a July 25 Disney call, now you've got a different option. And if you were to do that and you were long the April, you'd be long the April, short the July, because now you sold one that you didn't already own. Every time you buy in the options market, you either must let it expire or you have to sell. You're free to sell first, and that's what, of course, the writer or seller does, but then you're obligated to buy it back, or in the case where the option expires out of the money, you just let it expire. So the options are contracts in which the terms of the contract are standardized and give the buyer the right, as I've said, but not the obligation. It's important that I talk a little bit about that, because if you buy a 25 call and the market falls to 20, why would you buy it at 25? You wouldn't. So you simply let it expire. Now in that case, you're going to lose your premium money, but you won't lose more. You can lose up to 100% of what you put in. As a practical matter, as long as the option is trading, that option will have some value right up until expiration. So you can go right down to the final day when they're trading, you could get something for the option. I'm not saying you'll get a lot, you'll get an eighth or a 16th or something, but you'll get something. If you let it expire out of the money, as they say, and we'll talk about the in, at, and out of the money options in a second, you will not get anything back as the buyer. So they give the buyer the right but not the obligation to buy or sell a particular asset, which in this case is the underlying stock, at a fixed price, and that's known as the strike price, for a specific period of time, and that's expiration. The other term you need to understand that I'm going to talk about and I'll use in this video is the notion of being long and short. Long simply means you're a buyer. Short simply means that you're a seller. So those terms are used frequently in the market.